So, as Ellie said, we're going to go on to the issue about central bank balance sheets now, and that does have a certain link to what you've said just now. I think it's true also what Leonard said about there's a danger of central banks doing too much. And so if you just look at the statistics for the amount of bonds that the central banks do now own, it is really confirms the sea change that we've had in the last 15 years. It's just worth concentrating our minds if I just read out the statistics just to see how much has been going on and also which countries have been doing most of the building up of the balance sheet. So in the case of the Fed, for example, in 2007, before the financial crisis, the balance sheet of the Fed was about 6% of GDP. That's now gone up to 35%. So that's gone up by about 5 or 6 times. The Bank of England was 5%. That's gone up to 44% now. This is 2007 up to 2021. So at the time when inflation just started to be carrying out again, that's gone up 9 times. ECB, 12.6% was the size of the balance sheet because they had done a bit of balance sheet activity already in 2007. That's gone up to 60%, the highest of the 4 groups that I'm talking about. That's gone up 5 times. And Japan, which of course started quantitative easing much earlier, it already had 22% of GDP was the balance sheet of the BOJ in 2007, and that's now 136%, so well over 100% of GDP. That's gone up by 6 times. So you can see 2 things, really. One is that this has been a large effort over many years. Some people would say that the quantitative easing was carried on for too long in 2021. We can argue about that, but it's a relatively small factor compared with the momentum that has been built up over the last 15 years. And the second thing is it's going to take some time to dismantle the balance sheet, if indeed that is what the central banks would like to do. And it's a bit unclear. People talk about what should be a steady state balance sheet. So these questions are things we're going to be talking about on the panel here. And in the order in which they'll be talking, we've got Angel Ubide, who, as you know, is working now for Citadel, and he already has spoken a little bit about what's going on in the euro area. And Angel, I see you very much as putting the euro area's points of view here. You're going to be speaking first. And then we've got Andrea Fenig, who's the managing director and responsible for the collateral activities at Bank of New York Mellon, which, as we all know, is very, very close to the Federal Reserve of New York in terms of doing the tri-party collateral repo system. And one of the things I'd like to talk to you about, Andrea, is just whether this could be in some way transposed to Europe as part of the new system that the Europeans are trying to build up with a European safe asset. You know, surely you need a repo system to go with it. And then Emmanuel Dussmann, who will be talking about some of the auditing, some of the functional characteristics of all this as well, and some of the economic aspects from the point of view of Mazars, where he's the global head of banking. So first of all, Angel, there has been, of course, some talk about whether this build-up of the balance sheet is the right thing for the ECB to be doing, particularly in the Bundesbank, which has had a tradition of not intervening on bond markets. The very fact that 1/3 of all the German bonds ever issued are now owned by the Bundesbank is something where a number of former presidents of the Bundesbank must be turning in their graves, I would have thought. But could you give us also your views about whether this balance sheet, the size of that, needs to be run down at a relatively limited pace? Clearly, we're not going to see active quantitative tightening. There's you can explain about the APP and the PEPP systems if you want to. And also tell us a little bit about the way the balance sheet is anyway falling because of the TLTROs running off. And tell us also how this is going to be harmonized with what we consider to be still a moderate pace of ECB tightening. Very interesting to hear from Patrick Harkey yesterday about his gradualist approach. So you could try to feed that into your comments as well, please, Angel.
Thank you. And we have 3 days for that, or so let me make a few comments. I think I can comment on QT in abstract. It doesn't have to be necessarily about the ECB, although there are specific things about the ECB. But let me just frame it by saying 2 things. The first one is, and I'm speaking as an economist and as a student of central banking more than as a market participant, right? QT is not the negative of QE. I think that's very important, right? The effect of QE, especially if it's in an open-ended fashion, got the downside tail on the economic outlook, provide guidance on rates. Size doesn't matter, at least in my view, right? QE also, if you want, may improve intermediation, removes off the runs and other things. The mental effect that the central bank is saying the world that I'm going to do whatever it takes to achieve my objectives. QT doesn't do that, right? QT simply says the instrument to manage inflation and growth is interest rates. QT is something we do to reduce the size of our balance sheet, but it has basically nothing to do with of policy. It's not me saying it, it's the central bankers saying it because they say QT is going to run in the background on autopilot at a very small pace and the important instrument. So these are two completely different things, QT and QT. Now, starting from that premise, why are they doing QT? Why do they care about the size of the balance? So it's not needed from an operational standpoint. Now we know the Fed is running monetary policy with the overnight reverse repo facility. They have fixed the leak in the floor of rates. They can achieve whatever interest rate they want for a given level of the balance sheet. So it's not that. It's not an issue of creating a space to do more QE unless you are the ECB and you have the 33%. But if you don't have that...
Which is not, strictly speaking, a legal limit.
No. That's what I'm saying. So
yeah.
it depends on your framework, right? So if you feel that you are hitting a constraint that is self-imposed, then yes. But otherwise, I think we saw during COVID that regardless of the size of the balance sheet, central banks were able to do a lot more of QE. And in fact, normally, when you do QE, normally it coincides with periods in which there is an increase in debt to GDP, right? Because normally it coincides with periods of recession, periods of hitting the lower bound. So in some sense, there is a space that is self-generated, right? Now, the Bank of Japan would object to this and say, well, we got to a point where we were running out of bonds to buy. That's why we shifted to YCC. But that's a question of magnitude, right? Then there is the issue of losses, right? Central banks may lose money as interest rates go up, and that can create a reputational risk, can create political risk, and the rest. So that is true in theory. I still fail to say why the losses that they are recording right now is impinging on their ability to conduct monetary policy, but maybe it's too early in the process.
But surely it is a question of politics and perceptions.
Yeah, exactly. It's a question of politics, but so far I haven't really seen any material impact there. I could even say that the losses in the balance sheet of the central bank, and I'm going to be a bit provocative here, perform a sort of counter-cyclical role in the sense that imagine all those bonds that are today in the balance sheet of the central banks were in the private sector. Now, with a very rapid increase in interest rates, all those losses have been in the private sector. Right? The impact on economic activity would have been much bigger.
It's a very interesting point. I mean, it'd be interesting at some stage to get Jens Reich's view about all that, because you're basically saying that the central banks have been doing a good turn to the insurance companies and banks by buying all these overpriced bonds at high prices and now watching them sink in price. But that is a massive redistributional effect, isn't it, which needs to be thought through.
I'm not saying it's optimal. I'm saying that looking at it, it has allowed the central bank to raise rates faster and to a higher level, which is what they thought they needed to do to address the inflationary problem. So in that sense, it's not necessarily a bad thing. And so the question, and I'll finish here, is, what is the objective of QT? And the objective of QT is to achieve, as they say, the minimum size of the balance sheet that is compatible with an abundant reserves regime. Right? So it's about the liability side. It's not about the asset side. And about the liability side, it's an operational question. It's a moving target because the level of abundant reserves that is the minimum has probably increased since financial crisis, since the great financial crisis, has probably increased after SVB. Because if I were a bank today, probably I want to have a little bit more of a buffer just in case. And so, in the end, I think it's an interesting exercise. And then I'm sure we are going to talk a lot about the plumbing and the microstructure of money markets and the rest. But to me, it's still a bit of an issue of communication of why is QT, and I'll just leave it there.
Well, thank you. That's very helpful, Angel. On this point of losses, that's something, Emmanuel, you might also be talking about in a moment when, with your auditing and accounting hat on. Because I think there is something like a rule of thumb that says for the ECB, for every 1 percentage point increase in their policy rate, the system as a whole will be making an extra loss of something like 800 billion euros because of this gap between the assets and liability, the interest rates on both sides. So it could be quite appreciable, but I think it only becomes an issue if it becomes, say, page 1 of the Bild-Zeitung in Germany and not page 37 of the Frankfurter Allgemeine. And so it is very much a question of how it's seen in public. But we'll get onto that in a moment. So, Andrea, plumbing, that's your business, isn't it? You are the master plumber, or the mistress plumber. You tell us a little bit about the way that this works. And also, I know you don't want to talk too much about that, but could the tri-party system somehow be transposed to the European theatre?
Yes. So good morning, everybody. I'm delighted to be here with my esteemed panelists, and certainly a very timely discussion. So I just wanted to take a few minutes to review my role, because I'm not an economist. And so my comments are going to really be focused on the infrastructure that supports monetary policy delivery here in the United States. So just a bit of background. So I'm the global COO for the Bank of New York Mellon's clearance and collateral management businesses. So the core services we provide are global government securities clearance and settlement, as well as collateral management settlement. And on the collateral management side, we are the largest collateral manager. Current average balances are about 5.5 trillion. We have seen that spike to over 6 in some of the recent market volatility and monetary policy changes. But then also more applicable to today's discussion, I'm also the COO for a business and a company that we established. It's BNY Mellon Government Securities Services Corp. And that business provides really critical infrastructure for the U.S. financial markets. And that includes clearance and settlement of U.S. government securities, as well as tri-party repo. And we provide those services on behalf of the Treasury, the Fed, and other market participants, including FICC, the primary dealers, and the money market funds. So if we think about those activities, just generally, maybe I'll take a step back. So the Bank of New York has a very important role in the global financial markets. We manage 20% of the world's investable assets, so pretty significant. And while we're not considered traditional financial market infrastructure, many of the services we provide are infrastructure type services, such payments, global custody, and as I mentioned, security settlement and clearing, as well as as well as collateral management, So in the U.S., GSS is the largest collateral management agent. I mentioned we have 5.5 trillion in global assets, and in U.S. assets, that number is 4.5 trillion, so pretty significant. And in the main, that is almost entirely U.S. Treasuries and MBS securities, so basically any security that's eligible for Fed-eligible securities. What's unique about what we do is we provide access to our clients. They have direct access to the Fed through the arrangements that we have. And that allows for the settlement of the primary treasury issuance as well as secondary market activity. And this section of the market has grown significantly, especially since the March 2020 pandemic. And we settle on average $8 to $10 trillion a day. And we have seen that spike on certain days much, much higher. And that is really very much related to the volatility in the market. And the services we provide are directly impacted by changes in monetary policy, be it the quantitative easing or what we're seeing today as quantitative tightening. And I'll just give you some of the examples of that. So one would be, as I mentioned, We support our primary dealer clients in the settlement of Treasury auction securities. And when you think about as gross Treasury issuance goes up and down, that has a direct impact in terms of what we're settling and the levels that we're settling. And as David mentioned, we also support the Federal Reserve's reverse repo program that is supported on our collateral management platform. And this has definitely had a significant role in stabilizing the monetary stability since really since March 2021, when the usage in that facility climbed. And also, it's a lot, the money funds have seen a real influx in cash since March 2020, and they've had relatively limited alternatives for investment of that cash, so this has also proven to be important for them. So since June 2021, the facilities averaged about $2 to $2.2 trillion, and that represents about 40% of our total collateral management balances. So it's pretty significant. And these balances have remained high through the ending of the Fed's quantitative easing program and now well into the Fed's quantitative tightening program.
Just to be precise, of course, they're not selling directly. They're just letting it run off, aren't they?
Yes.
They're
yes.
just not reinvesting. That's
exactly.
The issue.
And I would just also say we've seen some of an uptick in the balances relating to some of the issues that we've seen in the regional banks and with the smaller banks as people are looking to move their deposits to higher earning assets, so they've gone into the money funds, and also some counterparties looking for more secured investment options, where collateral management provides a good outlet for that.
So I don't know whether you can say this here, and I actually don't know whether this is being live streamed. Is this being live streamed? Or oh, it is.
Okay.
You better be careful what you do say about this. But I know you did hint a few delicious little details about one particular bank, but you may not want to go into too many details about that. No. But you are very much deeply in the weeds, aren't you, of some of these little episodes we had in March. Yes. Say no more.
Say no more, exactly. And then just finally, during periods of volatility, I did mention this, in general, as monetary policy changes, especially now as we're talking about quantitative tightening, we do see significant bilateral volume spikes, and that generally accompanies increase in fails, an increase in intraday credit usage, and just generally an increase in credit cash buffers that are on deposit with us. And I didn't mention earlier, but I should. So when you think about the bilateral activity that we support, that is in the main uncleared bilateral activity. We also support the FICC, which is the central counterparty for Treasury collateral, and they clear. So that is centrally cleared, and the business that we predominantly settle is the uncleared portion of the bilateral market in the U.S.
Just before we go on to Emmanuel, given the fact that the central banks do own these very large proportions of overall issuance, as has just been said, do you find this question of a shortage of high-quality collateral, because this is tied up with the central banks, is this an issue that you need to resolve, or do you have sufficient flexible arrangements with, let's say, the security lending programs of various central banks? You can manage to get over that. I mean, I can understand this happening okay in the United States, where you're the Bank of Hamilton, but maybe in Europe you need to become the Bank of Helmut Schmidt or the Bank of Valéry Giscard d'Estaing to allow you to get into the plumbing mechanisms of the Bundesbank or the Banque de France.
Yeah, I mean, the U.S., the way the U.S. is structured in terms of our relationship with the Fed and Treasury is relatively unique. So all of the primary dealers of the 25 primary dealers have accounts with us. So when the Fed wants to enact different changes to monetary policy or provide support to the market, they leverage our platforms because all of the primary dealers are already connected. So that allows for really seamless ability for them to quickly step into the market to provide stability or liquidity or whatever the case may be. And I know in Europe, that's a little bit more fragmented. That's a little bit different. And I know that the Collateral Harmonization Group has been working tirelessly and effortlessly to try to find a solution, because some of the things that they're looking to develop, which is, increasing interoperability, making things a little bit more efficient, those are all the things that we see here in the U.S., and our program works very efficiently and extremely on an automated basis, right? So we've invested heavily in our platforms and have new state-of-the-art both platforms that settle or support the bilateral activity as well as the collateral management activity, and that is all seamless and completely automated, which I think then supports all of the liquidity efforts here in the U.S. and allows for very quick mobilization. And I think that in Europe is something that is taking some time to come to because the
nice
market's so
little
fragmented.
understatement there. You said slightly more fragmented, but with a name like FINIG, you should be able to roll your FINIG around the European markets, I would hope.
I can certainly try.
So, Emmanuel, you may want to talk about some other things, but I would certainly like to have your view about these losses, because it's not just the fall in the value of the assets on central banks' balance sheets, which if they're going to be held until maturity and redeemed at par, that's maybe not going to be an issue, because you don't have to mark to market, unlike some of the banks we've been talking about. But then, if you are a central bank, you do have this very big gap between the deposit rate. If you take Czech National Bank, they're paying 7%. Their bonds are mostly euros and dollars, where they're getting, say, 2%. They're making a loss. The Hungarians have to pay 13%. I know you are active in some of the Central European countries. There's this issue, too. The ECB's got a rule that says any member of the euro system, so that would include also countries which own the central bank, i.e. the Czechs and the Hungarians, they're shareholders, but they're not in EMU. They're not supposed to run negative equity for more than 2 years. And they've managed to sidestep that. So you might want to get into some of these more technocratic issues, but as well as anything else you want to tell us.
Thank you, David. A lot of good questions or points, but indeed you're right. The first, ECB is not the one that holds the bonds. It's your system, so it's domestic central banks that are doing that, but they are connected to states. So we're coming back to the point where we have this circle, which is you have this relationship between the budgets of the states, of the country, and the central bank. And so when you're running out of money in some countries in south of Europe, for instance, or France, and you're having your central bank making losses, that impairs your ability to have a relaxer or improve your tax policy. So that was mentioned yesterday in our bilateral discussion, I think, with Kartik, that people tend to forget from time to time that it's a stool with 3 elements when you're looking at the policy you implement. It's not only monetary policy or budget policy. It's not only tax policy. It's not only financial stability policy. They all come together. So, and the 3 all come together. So you have to have your tax policy, the budget policy, your monetary policy, and your prudential policy all together to make it happen in the economy. If you look at things in isolation, you certainly lose elements similar to this one, which is the country must, to a certain extent, have a capital increase when the central bank makes loss, which has direct impact on the budget and direct impact on the tax. But to have direct impacts on the tax, you have to go consensus, so parliament. So it's a bigger discussion, and indeed people want to have independence for central banks and monetary policy, but down the road, it's not so easy to implement. We want to believe it's possible, but it's not so simple, actually.
Do you want to make a comment about this issue of losses? And I can say that the IMF is looking at this, and I think I can say this also in public because it will be made public at some stage. There is a report that the IMF is doing on the losses of the European Central Bank system. It will be published at some stage. They've decided to do that. But from an accounting and a regulatory point of view, apart from the public perception point of view and the issue on the budget that you just mentioned, is there anything fundamentally wrong with central banks making losses? Because as Angel says, it could be just a way of withstanding general stress in the public system.
Did people see any question or issues with central banks making tremendous amount of profits in the past years?
No, but of course they didn't, because they paid that through to the Treasury.
So
that's the answer to that question. But you haven't answered my question, though. You simply put another question.
It goes back to Angel's point, which is it's contracyclical. So, and if this money would have stayed in the reserve of the banks, they could have afforded to make losses right now. The capital raise.
Well, thank you.
This is a timing, what's called cutoff issue. It's how you measure time.
No, thank you. I'd like to ask you, Angel, just going back to something that Leonard said, actually, which is shining through a lot of this debate, are central banks doing too much? I remember in Spain, in your country, when the euro crisis first broke, a lot of Spanish economists were really quite upset because at that time the doctrine of the ECB was not to buy bonds. And therefore, it was as though Spain had given away its currency to the euro area, and the euro was no longer a currency that Spain could control. So would you say generally that there's been a huge sigh of relief that the ECB has now become a more active central bank in terms of coming in to stabilize the bond markets, as it did with the SMP, for example, with Spain, and now more generally through more generalized quantitative easing? Has there been hats thrown up in the air, would you say, in Spain on that, just at the time when people in another country such as Germany might be rather gnashing their teeth about this new development?
Well, I want to speak as a Spaniard. I'll just talk about what monetary policy is supposed to be about, which is price stability. And inflation was way too low during several years in the Eurozone, and the ECB at some point corrected the stance of policy to achieve a stance that was conducive to achieving the 2% inflation objective. And that included cutting rates to zero and doing asset purchases. So I don't like to talk about the instrument that much, because then we are focusing on the nature of the instrument rather than on achieving the objective. And I think what happened was that there was a correction in the course, and now I think the ECB has the stance of policy that it needs to have, and it uses all the instruments that are at its disposal and consistent with its mandate.
Thank you. We just have a couple of questions here and then open it up to the floor, because there's lots and lots of different issues here. But Andrea, your bank is sitting right at the heart of the dollar financial system, and it's always a question that comes up on conferences like this, and we've heard a bit about it, whether the dollar will maintain its supremacy, which it is at the moment. It is the most important reserve currency. How important is it, these deeply liquid, functioning, hugely efficient financial markets that the Americans do have? How important is that to the fundamental role of the dollar? And could you imagine, when the European system becomes somewhat less fragmented, that will be also a very strong source of underpinning for the role of the euro? I stress when that happens.
Yeah, so some of those questions probably not best for me to respond to, but and we have a couple of Fed folks here that I'm sure would be better suited to answer that. But I do think for certain that the U.S. benefits from the deep liquidity of the Treasury market, and certainly our services help facilitate that in terms of being able to efficiently provide primary dealers and other counterparties direct access to the Fed so that they can easily purchase in the primary issuance as well as actively trade and settle in the secondary market. And then being able to take that collateral, those securities, and then seamlessly move it over to our collateral management platform for financing, which allows them to purchase securities that they may not initially have a use for, but our collateral management platform then allows them to finance them very seamlessly, also on a very automated basis, with a multitude of counterparties. In the main, those are the large money funds as well as the securities lenders. And that whole process, which has grown and evolved, especially since tri-party reform and a lot of the efforts post the financial crisis, I think just continues to support the U.S. market, and probably, as you've talked about, would benefit the European market as well, because that level of efficiency and connectivity between the collateral providers, dealers, and the collateral and the cash investors, and being able to seamlessly invest excess cash as well as finance securities, I think is really key to any financial market, and that a market's ability to be liquid and active.
So thank you. We've not spoken about the Bank of England so far, nor do I propose to, but somebody might want to bring that up because it is a bit of an outlier. It's had this enormously large increase in the balance sheet measured by GDP 9 times, as I said, and it's also the country that is the outlier at the moment. It clearly hasn't got inflation under control, and there's going to be more tightening to come. But I'd like to ask you, Emmanuel, just before we open it up to the audience, Just the same basic question, really, as I put to Andrea. Do you see Europe now, with all the various mechanisms that have been put into place over the last 15 years, including the European Safe Asset through the NGEU program, do you see Europe now being on the road towards a more integrated and more efficient and more attractive internal financial structure?
So that's a question which is interesting, because that requires to me to have the capital market union, which is not still in place and still in discussions for over 20 years now. Well, banking integration, I'm not saying it's perfect, but it's on its way. Started with first EB overseeing the banking regulation, the SSM creation. So, of course, resolution regime being implemented, even not used, it's implemented. That being said, as long as there is no capital market integration, you will still have very fragmented market. So you mentioned that, and when you think about QE and QT, it was mentioned, collateral fragmentation is an issue. Taking the example of Germany, actually, we were missing collateral in Germany. Quality collateral for securing operations. You know that to reduce the risk in the banking environment, you're using more and more, because that's mandatory, just to manage your RWA, your capital solvency risks. You're using collateral for your derivatives. But when the central bank buys all the good quality collaterals, or there is no emission, there is no issuance in Germany, or in France, or in Spain, the central bank buys everything. You don't have collateral anymore. You create tensions, and you price up the derivatives businesses. So
there is the securities lending program, isn't there, which the Deutsche Bundesbank, for example, the Banque de France would operate themselves. But sometimes they're a bit shy, I think, about sharing that and any possible rewards with private sector banks.
But you have side effects with that QE policy in the pricing of derivatives. That was externalities. That was not originally the pricing. So you create elements that were not here 20 years before, because you didn't use collateral in swaps. Okay, you were doing a blank swap, so no collateral, no exchange. I mean, credit risk and not liquidity risk.
Well, thank you for mentioning Capital Markets Union, because there's lots of people who also say without Capital Markets Union, you won't actually have a proper greening program. So, Angela, would you like to come back on that? And then please do start thinking of some questions around the audience.
No, just wanted to add, I mean, again, a bit more general. I think the issue is there is a little bit of a need of calibrating properly regulation and the plumbing, right, of monetary policy. Take the SLR, for example, right? One could argue that if the binding constraint today in the U.S. is the non-risk weighted ratios, then the amount of reserves is a sort of a binding constraint. Well, that can be solved with fewer reserves or changing the SLR. In the case of Europe, scarcity of collateral and other things, okay, it can be changed by reducing the size of the balance sheet of the ECB or by modifying at the margin some of the regulatory. This was, we built these things as we were going along, and now is the time to refining the coherence of these two parts of central banking. And I think we need to discuss it, right? Not perfect.
That's what we're here to do. It would be a good question also regarding banking union, whether it could be that a French bank will take over a German bank. It always used to be the case that the German banks were quite a bit bigger. I remember also years ago, when you talk to French bankers about this, they say, well, I don't really like the idea of being taken over by a German bank, which in those days, of course, had much higher capital, because the Germans are so much taller and stronger than we are. Somebody did actually say that. And even that isn't any longer the case. There would be no reason at all why a bank with a certain name, which actually applies to the name of the country, couldn't be taken over by a French bank, which happens to have a balance sheet and a capitalization appreciably stronger. So that might be something we could discuss as well. Does anybody want to put a question or raise a point? To start off with you, Mark.
Well, just to get the ball rolling, a very question mainly for Angel. How does your view about QT being different from QE relate to research conclusions I've seen, I think, out of the San Francisco Fed that said that basically QE is worth 50 basis points of
I don't know what to make of that research. I mean, I've done it myself. I don't think we have enough instances of QT to be able to have a lot of confidence, right, on how much it's worth. Running, event studies, when you have only, one announcement or two announcements in the industry is not that much. Let me put it this way. What I was trying to say is this. QE has 2 or 3 different channels, right? One is when markets are disrupted, it stabilizes markets. As I said, if you do it in an open-ended manner as the Fed did it and then the ECB, you are sort of selling insurance market and to economic agents that you are going to achieve your objectives. And then you are adding guidance on the amount of time that interest rates will be at. That's very powerful. How we quantify it, I don't know, but it's very powerful. When you are doing QT, you are essentially saying, I'm going to be selling assets at a very slow pace until I hit the size of reserves that I want, and I don't know what the size of the reserves that I want. It's not obvious how to price that. So to me, the impact on the stance of policy is very, very small. Whether that's 10 basis points or 25 or 50, I don't know, but it has to be small by definition, by the nature of it, right? Then sure, 25 or 50, I can.
So you've got the microphone, Angel, and also bearing in mind somebody from the Bank of England may be listening or on this live stream, so don't be too impolite about them. Could you put that into the context of the Bank of England? Because the Bank of England, of course, is now actively selling part of its portfolio under a program they started last fall. I think that's partly because the duration of the bonds that the asset purchase facility of the Bank of England has is substantially longer than at the ECB. But could you just then throw the Bank of England into the equation as well?
But it's the same thing. I don't know what the target size of the balance sheet of the Bank of England is, and I don't think the Bank of England has told us, right? And so when they announce the active reduction of the balance sheet, they basically said that we are going to do it until we think we have done enough. But we don't know what enough is. So from the point of view of the stock effect, we cannot really assess that. The flow has to be, by definition, very small. And again, I'm not neglecting the microstructure issues, and obviously, there is a lot of issues in the money markets where this has an impact. But from a big macro standpoint, it's just difficult to think that it's going to have a big impact.
We could hear from our central bank friends around the audience. There's Chiara, there's Joe, there's Etienne, and there's Jens. Maybe we could start with you, Chiara. In terms of the optimal balance sheet, all people are saying is that they think the balance sheet will have to be higher than it was in 2007, aren't they? They're not saying much more than that. But this question that we put here, why QT, is it also just a sign that they can show they can do things? They can do things on the way up, they can do things on the way down. Is it a kind of virility symbol that the central banks are showing that they do have the ability to command this important factor, which is the balance sheet?
That I alluded a little bit at these issues I was talking, and I think that I was very much in line with what Angel was saying, when talking about QE and QT. In my case, was like forward guidance, at the ELB versus now. And I think that I was coming with a very similar point of view based on, some of the research that I've been doing. In terms of the optimal size of the balance sheet, I think that, and this is my personal view, I'm not sure whether, it has already been established what it is. I think that we will need to, central banks are doing QT, they are reducing the size of the balance sheet, and I'm sure that, there will be some hiccups along the way, but it would be informative to understand, where we will end up
It
and where
is.
we should
I
end
think
up.
you're right. It is a useful experiment. I mean, with the tables are being turned now. So, Joe, the Kansas City Fed's got views on almost everything. You must have a view on the optimal side of the balance sheet. And then we will go to Etienne and Jens to ask them to comment on anything they might like to comment. And we also have, of course, Antoine.
I think these are really good questions, and I like Angel's intervention there. I mean, this was one of the questions we actually had at Jackson Hole last year, where I talked about it yesterday, but it was reassessing constraints on policy, right? Policy and the economy. Part of that was looking at the supply side. But another one was thinking about the potential cost of QE and what are the constraints, right? So crisis, basically, it wasn't quite clear what the constraints were, and I don't know if they've been formalized, and I think that's the question that you're raising, and I think it's really the other thing that brought up that I think is really interesting is the channel of QE through interest rate risk, and I don't know if that's really been looked at all that much, right? So basically, as interest rates go down, a certain amount of interest rate risk is banks, but through the use of the balance sheet, the Fed has basically taken on a lot of the interest rate risk, right? Which might have made the decline in rates more effective, I would say, through the conjunction of those two. And so I think it's a really interesting channel. It's one I've been thinking about, and it was interesting to hear you about too. And I don't know if it's really been all that much.
So the Bank of England deserves some kind of prize, perhaps, because it is, after all, adding in a laboratory-like fashion to the data. Let's go to you, Etienne, since the Banque de France was mentioned. So let's have your view on anything that we've been discussing up to now, and also obviously put a question as well if you'd like to, or just give us your view.
Yes, sure. Of course, it's only my personal view, but I think I would fully...
Is your microphone on?
I hope you can hear me. So, of course, this is only my personal view, but I would fully subscribe with one of the first comments that was made by Angel, that what is striking at the moment with QT is that have a very clear message on the direction of reducing the size of the balance sheet, but there is a high uncertainty on the final target size of the balance sheet for all the central banks that are involved, and also during the uncertainty of what has happened recently on the banking sector, on the US or in Europe, we have a high uncertainty until point we should carry on with the QT will be the optimal size of the balance sheet in the few months or few years to come. So striking point at the moment, and by Angel.
It's good. I think there's nothing wrong with agreeing with Angel. That is always a safe bet, I would say. Jens, the finger is pointing to you because the Bundesbank has, after all, been quite strong in saying that they would like the reinvestment of the special facilities to be stopped, and indeed the APP reinvestment is being stopped as of now, isn't it, this month? And the PEPP will go on. But the question which was put, why is this a subject of concern?
Yeah, thanks. I want to make two comments before I answer that, because you raised more questions before. So I think the first question you raised was on central bank losses. I think it's even more complicated because different central banks in the Eurozone treated hedged interest rate risks in different ways. And I don't even know if the French central bank has incurred any losses so far. So I think there is it was a very active decision on how you go into this process. And the way the Bundesbank set it up was we went into interest rate risk, knew it would hit us, and therefore we would retain earnings to a degree which will for some years cover the losses. How long that works out, but I mean, I think that was an active decision to deal with it. And if we would bother about the losses, works now, and it's.
And would the easy way of getting around it just to put in some kind of revaluation reserve?
I'm not saying this is proposal by Bundesbank or any participant in the European system of central banks, but I mean, reduce the remuneration on reserve requirements and increase the reserve requirements. I mean, then
it could be a bit controversial, but it could be done.
But I mean, let's say the ending of the TLTROs could have been also controversial. Okay, but that wasn't my comment on the losses. I wanted to comment on the asset purchases. So we didn't need the financial crisis to do asset purchases. We always had the agreement between the member central banks that we make purchases of assets. Whenever the Spanish or the French would like to buy assets, in particular government bonds, they could do that even before we had all the Ps, all these programs. Bundesbank never liked to do it. And so the question on the balance sheet, I like to look at it from a monetary implementation point of view. And I think it's not that important what you think of the size of the balance sheet. I think the more important question to me was, how do you want to implement your monetary policy? Do you want to stay in an excess reserve system like the Fed wants to do? They really want to have excess reserves, supply-driven excess reserves. And then the question is, well, what's the optimal size of the balance sheet? I don't know. Well, too much, more than there's demand. Question is, do you want to keep it that way, or do you want to get close to the old system? And the way, I mean, Isabel Schnabel has a nice talk on that, which she gives. She had it in New York a few weeks ago, saying, well, we want to get close to where we were before. We want to kind of have a demand-driven excess reserve system, but it's getting way closer to, and it will take a long time, but we will get way closer to the system we had before. And on a personal note, I like the old system more than the new one. And for us, and the way we set up, I mean, we always had interest rates. And whether it's the lower interest rate, which is binding, or the middle one, like the main refinancing rate, I mean, that doesn't make too much of a difference. But I think politically, it's way easier to defend monetary policy if you're charging banks interest rates than if you're granting a subsidy to those who hold the excess reserves. And it may pop up in some time in the future. It didn't pop up now, but it may come up at some point in time.
There is this view, isn't there, that getting 3.5% risk-free, which just goes into your bonuses or whatever, is not a good use of public money, and that has come up, hasn't it? Could you, just before we go to Antoine, could you just comment on this rather mystical question of the 33% issue and issuer limit? Because this is not a legal issue, and somehow the Eurosystem's managed to get out of this by separating out the APP and the PEPP bonds, because if you add them all together, clearly some central banks are up to 40%. Is this a binding thing? Does this feature in your dreams or nightmares?
I have to comment on that. I mean, can I say something personal later on? Would that be fine?
Okay. No, you're perfectly allowed to do that.
Thanks.
Simply because we've realized that all this might be live streamed. So it's kind of Big Brother or Big Sister, perhaps, watching you. Antoine.
Yeah. So, from a personal view, of course, and I agree with everything my colleague said, and I think we can add a little bit more color in terms of the questions of balance sheet. So the FOMC has said they want a large balance sheet. We know that. And we don't know what the size is, but we have really good ways of knowing when we get close to that. We have the experience of 2019 that tells us a lot about what's going to happen. Money market rates will tighten compared to IORB. We're going to observe volatility. There's new research, including by my colleagues at the New York Fed, John Williams, Gara Alfonso, Gabriela Espada, that have ways of measuring practically in real time the elasticity of the demand curve for reserves. This gives us a really good way of knowing we're getting close. So then the real question, if you're in the market and trying to make money, you have to sort of guess where that is. If you're a policymaker, you just have to know where to stop. And you can look at these real-time indicators, so you don't have to necessarily make guesses. If you're in the market, you have to make guesses. And then I think the real question is, that's difficult. There's a bunch of new academic research that tries to make the argument that perhaps it scales with GDP, perhaps it scales with deposit banks. And we'll get more information. That'll be interesting to find out. From the perspective of whether or not this is a system that's sustainable in the long run, and this goes to your question about why we want to balance sheet, you can't just always grow the size of the balance sheet because then you run into trouble, right? So if there is any sense in which you have hysteresis, that QE creates a limit that's ever growing, then central banks are going to run into trouble over time. And some academic research has been arguing that you have such a problem. Now, I don't think there's any evidence of that yet. And if you scale with GDP or if you scale with the bank deposit, then that goes up and that bank deposit go down too. But the system doesn't blow up in a problematic way. So I think the real interesting question for central bankers is where do we find evidence of hysteresis, of rushing up effect? And as long as we don't, then the system is sustainable, and we have good ways of understanding what it can.
So thank you. Well, I think that's helped my understanding. Anyway, we'll go back to the panel in a moment. because everybody seems to be agreeing with Angel about the fact that it is a good question to put. Why are you doing it? You see, it reminds me a little bit of that film with Peter Sellers, Chauncey Gardner, being here, and it's like a garden. It seems to be that if the balance sheet is like a garden, then you let it grow and you let it all hang out, and lots of leaves and lots of new verdure and so on during the summer, and then in the autumn maybe you cut it back. And so maybe it is like a garden, and it's all down to Peter Sellers. So please, jury.
Curious to hear more thoughts on the composition of the balance sheet. Obviously, big difference on what the Fed is doing, and just when thinking about the unintended consequences or intended consequences, one of the things we've heard from the Fed has always been they keep expecting reverse repos to be the one that comes down. Excess reserves that's coming down and not reverse repos. And no one seems to care until some banks blew up, and then maybe we thought, well, maybe we want to know a little bit more about why certain pieces should be at an equilibrium point or not. So I'm curious to hear thoughts on whether the composition is a question that should be actively pursued and pruned as opposed to just the size.
So, Andrea, just from a strictly technical point of view, rather than from a policy point of view, do you want to make a comment on that?
Yeah, that is probably better for my panel colleagues. But yeah, I mean, listen, we if you think about our total collateral management balances, which I mentioned, it's about $5.5 trillion on average. So 40% of that is the reverse repo program, which is pretty significant, and we've seen it stay relatively stable through quantitative easing and tightening. So, it seems to be, well, and part of that is obviously due to the money funds having a lot of excess cash coming into the funds and now having limited opportunities to invest other than the reverse repo facility. So, bills is one area where they tend to like to invest, but the rates and the volume of bills has not, has come down due to the debt ceiling discussions, which probably will change now that it looks like we're close to the resolution. So it's a facility that I think is important because it is actively utilized. I'll leave it to my colleagues though to talk a little bit more about composition of the balance sheet and whether we should be focusing on that aspect of it as well.
Thank you. Yes, so Angel and then Emmanuel, please, on that point.
So a couple of points. One, and I forgot to mention before, Mark, at least some people are arguing that you can continue to do while cutting rates. Right? I think Governor Waller has mentioned that, and a couple of. So related to the issue, does it really have an impact on the stance of policy? Well, I'm pushing at the same time if it did. So just as an anecdote. And I think the issue at the end, and I go back to what I was saying before about making the operation of monetary policy, is the nature of banking changing, right? So now we know that markets are going to look at the holdings of government bonds and do the mark-to-market exercise, even if it's right, kind of thing, right? So if banks have to hold an LCR that can be reserves and bonds, fair to think that maybe they want to have more reserves and fewer bonds because reserves are not going to the market? Question mark. I have no idea. But that is something that it might affect the minimum level of reserves, right? And I think this is the kind of questions that we need to think about in terms of where are we going. And that's why, to me, this is a moving target. And at the end, I think my summary of this conversation is we are thinking about the balance sheet from the point of view of liabilities and reserves, not from the point of view of. And to me, that's the most important thing.
Manuel.
Actually, I was preparing this session for today. That's the point I was thinking about, is how you strike the right balance on the banking side, not on the central banking side, between your securities investment for your HQLA and LCR requirements, for the ones that are under Basel rules, and your reserves. So, and that was, you want certainly right now to have a kind of buffer, more than a couple of months ago. And really that was, and that circled back to one of the comments that was made earlier during the panel, which eventually we might need to revise some of the metrics we used after the crisis in terms of where is the right balance for LCR, where is the right balance for NSFR. We've done all of that in the wake of this crisis in 2007, 2008, 9. But is it that time now to rethink those ratios and eventually to define? Also, from the balance sheet side, there is no forward guidance on it, and that's eventually a point for long-term rates. The central banks want to use the monetary and interest rates for long-term rates, but does it diffuse the same way when you use QE and QT and only the monetary policy for short-term rates in the longer term? Especially when you consider how you assess solvency, RWAs, and that you have, don't forget, those rules that have been implemented about the size of the market-making portfolio of banks that also changed after the crisis. So you cannot absorb the same way, changing the securities and as a dealer. So don't forget that banks cannot do anything else now that market-making, but they don't have the same capital allocation to do that. So the inventory they are on balance sheet is limited. And that's why you have also those non-depository institutions that are actually market-making much more than banks and that absorb that. But it comes back to the asset allocation point. Preparing for this, yes, that was one of the questions. How you rethink your liquidity strategy from a banking perspective? You define your right allocation also of assets. Do you want to be muni bonds to bear a credit risk top of the federal risks? So what do you want to have in your treasury portfolio?
Did you want to make a comment on that, Andrea? You seem to be indicating broad approval there.
Really nothing to add on that one.
Yeah.
I think it was well said.
I just want to finish with just one very quick question, which ties in also with the greening and the sustainability and so on. But I just want to make sure that nobody else wants to put a question. Mark, this issue, I'd quite like to just get your view before we just go to the very final short question on this issue about losses, because you said from time to time in the United States system, you would clearly devise some accounting methodology to get around this. It's a bit more complicated in the euro area because of the complicated shareholder structure and so on. But do you think the Europeans are just making a fuss about nothing?
A year ago, I did a OMFIFT discussion with Bill Dudley and Ellen Mead, Monetary Policy Division head. And the feeling was that the Fed making losses is not like an economic and a financial, essentially a political issue. If people wanted to use that as a handle to attack central bank independence, Fed, and whatnot. But Bill was very clear to point out that the losses that the Fed is now would now be making are peanuts in comparison with all the profits of the past. And even if you make assumptions about losses over the next 2 to 3 years, they're going to be peanuts in comparison with the past. So, to me, political issue, potentially a political issue. Hopefully, it doesn't become a political. I think, given how messed up the U.S. is with our complete fiscal non-policy, that you need a flexible tool for stabilization, and it's got to be for monetary policy. And if we do the monetary policy what we've done in fiscal policy, our country's in big. So I hope it doesn't become an issue. I'm a strong supporter of central bank independence, but I don't really see this as a...
No, well, of course, it will depend a bit, won't it, if anybody wants another stick to beat the Fed in the election year, but let's cross that bridge when we come to it. I just did want to ask very quickly, in the same order in which they spoke, so starting with Angel and then Andrea and then finally Emmanuel, this issue about whether there should be a place on the balance sheet for what you might call green assets. The ECB does, for instance, have about 340 billion of corporate bonds. It has been doing this, tilting towards relatively environmentally friendly corporates. Very quickly, just to round off, Angel, is that the place where the central bank should be?
I'm going to not answer the question by saying that what I would like to see is a way of rating bonds, green or not green, in a way that we can all agree. Because otherwise, I don't know what they're buying or not.
Well, that's another one where I think most people would agree with you, Angel. Do you have a point of view, also from a more technical point of view here, Andrea, on this issue? The same thing would apply, wouldn't it, the rating?
Yeah, so as it relates to the Fed balance sheet or central bank balance sheet, I'll defer. But I will add, though, we did have a lot of interest from our clients to add. So we have all these different types of collateral schedules where clients can determine what type of collateral they want to take for their cash investments. And we have added a number of ESG indices and the ones that most of you are aware of. So there's availability for clients if they do want to screen their collateral around ESG eligibility. The only thing I will add there is that we have not seen a lot of uptick, and I do think a lot of that is, basically because there's just uncertainty in terms of, what the meaning of it is, what the, how you're looking at the bonds and all. But we do, we are very conscious that that is an important topic, and we're trying to, as best we can, in our sort of role as an infrastructure provider, support the market.
Emmanuel, is this a good thing for central banks to be doing?
So that will be my point of view, just my point of view. I think I haven't seen that in the mandate. Thanks. So I'm wondering, really, do we change the mandates of the central bank? Are they here to decide where to invest? First, I fully agree with Angel that what's the metrics, what's green, how do we qualify green, what's green, what's brown, what's deep green, clear green. I don't know that. Second is it is the role of the monetary policy. Is it a political question or a monetary question?
Good. Well, let's leave that hanging delightfully in the air. So the phrase of the session has been, I completely agree with Angel. So that will go down, I think, in history as the most used phrase in this session. So thank you all very much, Angel, Emmanuel, and Andrea, and thank you also for taking part as well, our central banking friends from the audience. Thank you for being part of the panel. So thank you very much, all of you.